You are in the process of applying and taking a personal loan. Congratulations and best of lucks. There is a number of terms that you need to know when you're applying for a personal loan. You have to understand exactly what is it that your loan officer is talking about. I work as a loan officer. When you call a bank to get a personal loan, you're speaking with me. That's it. So I know exactly what is the terminology that we use. And you have to know it. There's three reasons. Number one, the better prepared you are, the better the chances that you are going to sign for exactly the loan that fits what you need and not what somebody else's needs. Number two, us loan officers, and I know this, we use terms that are very common to us, but not for everybody. So by knowing these terms beforehand, you will be able to know exactly what we're talking about. And number three, guys, there are some personal loans that are not for you. So if you don't know what your loan officer is talking about, then you may be signing up for something that was not in your plans. So let's just go ahead and get started. The first four, and most likely you already know this: the principal, the term, APR, and payment. Very simple, guys. Principal is the amount of the loan, is the amount that you're signing up for. It is basically the amount that you are requesting and that you're going to be getting. It's known as the principal. Sometimes we say the capital, but most of the time is the principal. Term. This is how long the bank is giving you so that you can repay that loan. Most of the time for personal loans, these are expressed in months. 12 months, 6 months, 48 months, 60 months, 72 months. Make the calculation. How many years is 12 months? 1 year. You will be surprised, guys. Not everybody knows these things right off the bat. So that is the term. Interest rate is also known as APR, annual percentage rate. This is the interest the bank is going to charge you every year on the principal. Starting to see how we use these words? Payment or monthly payment. This is it. This is what you're going to be paying every single month. Your monthly payment. Principal, term, APR, payment. Pretty easy. Not everybody knows these things, guys, right off the bat. Can you believe it? When it comes to the interest rate, there are two things that you have to know: fixed interest rate, variable interest rate. They're not the same. Fixed interest rate is when you sign up for a loan, and for the entire term of the loan, you will be paying the same interest rate, the same APR, the same annual percentage rate. It's not going to go up, it's not going to go down. When your loan officer tells you that you have an approval of $8,000 for 60 months, 5 years, with an APR of 17%, it means that for the entire 5 years, 60 months, you are going to be paying 17% every year on the principal of the loan. Variable interest rate. Good Jesus, man. Okay, now we are entering a part of personal loans which start to turn pretty gray. Personal loans by banks, credit unions, and other financial companies always give you a fixed interest rate. If I can tell you something based on my experience of more than 15 years working in banks, many of these years as a loan officer in personal banking. Variable interest rate? No. If they say the interest rate is 17% variable interest rate, hang up the phone. Yes, hang up the phone. Say, no, thank you, I'm not interested. Hang up the phone. That is not for you. Most of the time, this variable interest rate, they tend to go up. Guys, these things don't go down as much as they promise you that they do. And because it's variable, you may have other fees and other things. So I mean, you do you, but variable interest rate, run, Forrest, run. Secure loans versus unsecured loans. You see the difference? Unsecured, secured. Unsecured loans is pretty much what we consider to be a normal loan. You show proof of your identity, your address, your job, your income, your expenses, and based on that information, you get a loan. Let's just call it the traditional personal loan. Secured loan is when the bank requires you to use collateral. There you go, another word that we use very often, collateral. Collateral is something that you have to put down to guarantee the repayment of the loan. Most of the time, a collateral is synonymous with a vehicle, with a car. What can you use as a collateral for a secured loan? Cars, trucks, motorcycles, boats, campers, RVs, trailers. Anything that has a title, registration, and insurance. That is a collateral. Now, why choose one or don't choose one? Sometimes you don't have a choice, guys. Sometimes the bank is going to tell you you qualify only for a secure loan. This could be because your credit history is fairly recent. It could be because there is some late payments or some charged offs. Or it could be because the amount that you are requesting requires a collateral. Oftentimes, the bank will give you an approval both for a secure and for an unsecured loan. Keep in mind one final thing. Secured loans in general have lower APR and you can borrow higher amounts. This is obviously depending on what you put as a collateral, right? A 2001 Ford Fiesta with 315,000 miles used as a collateral may not give you the same as a Ford F-150 2020 with 60,000 miles. You understand the difference of the collateral? Is not the same. Finally, secured loan is also referred to as hard collateral required. When your loan officer says, oh yeah, you qualify and this is a hard collateral required loan, it means that you have to put the title of a vehicle that is under your name to secure or to guarantee this loan. Hard collateral required. All right, now let's move on to origination fees or prepaid fees. Banks are going to charge you interest on the amount of money that you borrow. They're also going to charge you a late fee if you don't pay on time. And on top of that, they charge you something called origination fees or prepaid financial fees. This is that right at the moment when they give you the loan, just for the trouble of them having someone like me review your income, your expenses, and your credit report, they're going to charge you some money. I know, right? Like if it's not enough already what they are charging you, well, they are going to charge you even more for the trouble of processing the loan. That is called origination fees. Sometimes they call it prepaid finance charges. I mean, there is a bunch of names for it. One thing to keep in mind with this prepaid fee, yeah, all banks have it. I would say 99.9% of banks have prepaid fees. Of course, that's what banks do. They get you at the beginning, in the middle, and at the end. But anyway, listen to this. These prepaid fees, there are two options. One is that they will take that amount from the principal. So if the prepaid fee is, let's just say, a flat $100, and you're taking an $8,000 loan, then you're not going to be receiving the full $8,000, but you will receive $7,900. and the bank will take their $100 origination fee. You understand? Other banks use a percentage of the loan that you're taking. And guys, some of these percentages can go up to 10, 8, 12, 15%. Let's just go ahead and do the same example. $8,000. The bank charges 10% origination fee. Okay, so you're going to be getting $7,200, and the bank is going to take their $800 right at the beginning. There are other banks that add these origination fees to the balance of the loan. Going back to the same example, a loan for $8,000, and they charge 10%, which is $800. That means that you're going to be signing up for a loan in the amount of $8,800. You are going to be receiving $8,000, and the $800 is what the bank is going to keep. Now consider the following. When they add $800 to your balance for a term of 60 months, 5 years, it means that you will be paying interest on the $800 origination fee. Yep, it will happen. Prepayment penalty. This is a question that you should ask right at the beginning of the conversation with your loan officer, or you should look it up with the bank before you apply. This is called a prepayment penalty. Prepayment penalty. Can you imagine? So you take a loan. Let's just get back to our same example, $8,000 for 60 months. Well, it turns out that 12 months go by, 1 year, and job is going well. You got a bonus, and you say, you know what? I'm just going to go ahead and pay off this loan. I don't want to go the entire 5 years or 3 years or 4 years or whatever. I just want to go ahead and pay it off right now. Well, prepayment penalty is when if you're going to pay the loan before the term, they're going to charge you additional money. It could be that you will have to pay the entire finance charges for the entire 60 months, or that they will charge you like an additional $500 just because you want to pay off this loan. Ask the question. Default. But this is when you don't pay on time. That's the technical term, default. That's what we use. When someone doesn't pay on time, that is considered default. Cosigner or co-applicant. This is something that your loan officer may bring up to you. This is when someone else sign up the loan together with you. Or it could be the case that someone asks you to a cosigner. Now, what is the point of a cosigner? Well, it's two people, two incomes, two credit reports. Sometimes there are people that don't have enough income, or the credit score is not high enough, so they are required to have a cosigner. Guys, a cosigner is a double-edged sword. When you sign up as a cosigner for someone else, family member, a cousin, a son, a spouse, just know that you are in the hook for those payments if that person doesn't make that payment. If it's your spouse and God forbid something goes bad and you get divorced and that person stops paying, guys, you have to pick up the payments yourself because you are liable for that and it can damage your credit history. Now, if you co-sign for someone and that person makes all the payments on time, good for you, right? It shows that the payments are on time. But always understand that when a co-signer is added to the loan, is because the signer, the main person, may not qualify without someone else. So keep that in mind. That is a co-signer. DTI. Now we're coming into some specific terminology here. DTI, debt to income ratio. This is a percentage that calculates your income against your debt payments. It's a percentage, right? If your income is $3,000 a month and you're paying $1,000 a month in credit cards and personal loans and all that, That is a 33% DTI, debt to income ratio. NDI, net disposable income. NDI. This is a number where you take all of your expenses minus your income. The difference is your net disposable income. Is what is left from your income after you pay everything. Not just your credit card and other financial obligations, but your rent, your personal expenses, or whatever that is. NDI, net disposable income. May I say something just in case maybe this is not clear for someone? To take a loan, your income has to be higher than your expenses. Okay, makes sense? Because when you're taking a new loan, you're adding a payment, and your income has to be higher than your expenses. Otherwise, how are you going to pay for it? I mean, I'm just saying, some people don't know these kind of things. All right, we're getting closer to the end. Credit score and credit report. It's kind of like the same, but it's different. Credit score is a number that the credit bureaus give you based on your payment history, length of time, credit utilization. That is a credit score, and it's a number. It can go anywhere from 300 to 850. Credit report is the breakdown of every single debt, credit card, personal loan, car loan, mortgage, everything that you have taken throughout your life is in the credit report. There are some banks that don't quite look at the score itself, but they review the credit report, and they go line by line, seeing what you have active, what you have paid off, and if there is something that was behind or was charged off, we ask you questions about it. Loan amortization. This is a very technical term that gives you the payments that you have, the term that you have. That is called the loan amortization. It's the number of payments that you're going to be making during what period of time. Fancy term to say something very simple. Hard pull, hard inquiry. This is something that gets everybody like so afraid. There are some people that, we tell them about the hard pull and they're like, my goodness, are you going to pull my credit? Guys, we're not going to be running over your puppy or anything like that. A hard pull is when a bank accesses your credit report. And by doing so, the credit bureaus take some points out of your credit score. Based on my experience, is anywhere between 3 and 5 points. Why are they taking the points if it's your report and it's your history? But I have no idea, guys. I don't agree with it. And if it was up to me, I would remove that yesterday. But that's the hard inquiry. Every bank, credit union, financial institution that is going to give you a credit, they want to access your payment history, your credit report. Hence, they will do a hard pull or a hard inquiry. Let me be the one to say that it's not a big deal, guys. 3 to 5 points. That's it. Late fee. That's when you don't pay on time. If your payment is the 20th of every month and you don't pay on the 20th, then you're going to get a late fee. Grace period is when the bank says, okay, you have 5 days, 7 days, 10 days before you get a late fee. That is known as a grace period. So if your payment is due on the 20th and the grace period is 7 days, then by the 28th, you're going to get a late fee added to your loan. Debt consolidation loan. This is really the number one reason why people get personal loans. To consolidate the credit cards and other debts into one single payment. Debt consolidation. Total amount of the loan. This is a question that you want to ask your loan officer, even though you can make the calculation, but the total amount of the loan, basically you are going to take your monthly payment and you're going to multiply that by the term, 60 months. That is going to give you the entire amount of money that you will be paying during the entire term of the loan. It includes the principal, which is the amount that you receive, and all the interest that the bank is going to charge you. Total amount of the loan. Always ask this question or make the calculation yourself, and you will know how much this is going to cost you. There you have it, guys. Key terms to know before you apply for a personal loan. Man, you are head and shoulders above anyone else. Let me ask you, do you know what questions you should ask your loan officer before taking this loan? Questions that you have to ask? Worry not, I got you. This video over here is gonna give you the questions that you have to ask your loan officer. Down below in the link, you're gonna find a free guide of all the terms that we discuss here. Click on it and get it. All right, guys, there you have it. Key terms. Thank you very much for watching. I am Jose Gastaldi, your friendly loan officer. Good luck with your personal loan. And remember, go ahead and get this thing.